Hello, this video is specifically recorded for TYBcom students. Subject is Financial Accounting, Chapter Investment Account. Mumbai University Solution, April 2016. Personal Investment Account, April 2006. So this was the question which was asked in the exam of Mumbai University. Let us try to understand this question. On 1st April 2014, Mr. Ramdas held 1006% central government bond of rupees 100 each at a cost of rupees 96,000. So now if you see, Mr. Ramdas is an investor. He is purchasing 6% central government bond, 1006% central government bond at the rate of rupees 100 each. So the face value will be 1 lakh rupees. How we got this 1 lakh? 1000 into 100. And the cost of this investment is 96,000. Face value is 1 lakh rupees, but the cost is 96,000. Next, interest is payable on 30th June and 31st December every year. So the due date of interest is 30th June and 31st December. There are two due dates. So I will request you to underline this, as this is little important. He entered into the following transaction in respect of 6% central government bonds during the year ending on 31st March 2015. Now during the year there were few transactions, like he did purchase of investment, then he sold some investment. So these are the transactions which are given below. So let's see. Purchases on 1st May 2014, face value of rupees 20,000 at rupees 102 each cum interest. So this is a purchase. Now in this, cum interest is important, so you are going to underline cum interest. Next, on 1st September 2014, face value of rupees 60,000 at rupees 105 each ex interest. So underline ex interest. Sales on 1st August 2014, face value of rupees 30,000 at rupees 104 each cum interest. So underline cum interest. Next, on 1st February 2015, face value of rupees 30,000 at rupees 102 each ex interest. Underline ex interest. Show 6% central government bond accounts in the books of Mr. Ramdas for the year ended 31st March 2015. Market value of his entire investment was rupees 1 lakh on 31st March 2015. So again, the last sentence is little important. At the end of the year, the market value of his entire investment will be rupees 1 lakh. So this thing we'll have to remember. Now let us start solving this question. So this is how you will have to prepare an account, an investment account. So you will write in the books of Mr. Ramdas, 6% central government bond account. This is little important. Interest part, you will have to write the interest due date on the top of the investment account. So there are two due dates of interest, 30th June and 31st December. So we will have to remember this while doing the transactions. So this is how you will have to prepare the columns: date column, particular column, face value column, interest column, cost column. So this is your debit side, and same way for credit side: date column, particular column, face value, interest and cost. So this is your credit side. Now you will have to record the year, financial year of which we are recording the transaction. So our financial year is 2014-15. So you will have to record on both the sides. Done. So let us start. Let's see what the first transaction that we have. On 1st April 2014, Mr. Ramdas held 1006% central government bond of rupees 100 each at a cost of rupees 96,000. So this is the opening balance. So let us record the opening balance. So we will say 1st April two balance brought down. Face value is 1 lakh. interest. Now we don't know the accrued interest because this information is not given in the question also. We don't know the accrued interest of the opening balance. So we need to calculate this accrued interest. Let us go to the working note and calculate accrued interest. So we will say first working note, accrued interest on rupees 1 lakh, because 1 lakh is the face value, as on 1st April 2014 for 3 months. Now why 3 months? Because the previous due date was 31st December. So from 1st of Jan you have not received your interest. So 3 months will include Jan, Feb and March. So we will have to calculate interest on the face value, and the face value is 1 lakh. So 1 lakh into 6%. For how many months? For 3 months. So 3 divided by 12 will give you how much? So let us calculate. One lakh into 6% will give you 6,000. So 6,000 into 3 divided by 12 will give you 1,500. So let us record 1,500 over here. So this is the accrued interest on opening balance. So let us record accrued interest as 1,500, and the cost is already given in the question. So the cost of this opening balance is 96,000. So we have completed the first transaction. Now let's see what is the next one. Interest is payable on 30th June and 31st December every year. Fine, we have recorded this, we have written this on the top of our investment account. He entered into the following transaction in respect of 6% central government bond during the year ending on 31st March 2015. Okay, so these are the transactions. So first transaction is purchase on 1st May 2014. So after 1st April, the next transaction is on 1st May. Okay, we don't have any interest date between these two dates, so we can go for this transaction, purchase transaction. So 1st May 2014, face value of rupees 20,000 at 102 each come interest. So we'll have to go to the working note, because this is your come interest price. We will have to, come interest means including interest, we will have to exclude interest from this. So let us calculate the interest part. Purchase as on, the date of purchase is 1st May 2014. So our come interest price is, now you should know how many bonds actually you purchased. In fact, he purchased. So 20,000 is the face value, and per bond is of 100 rupees. So 20,000 divided by 100 will give you 200. So 200 is the number of bond purchased by him. So let us update here. 200 bond he purchased at a price of rupees 102. Let us calculate. 200 into 102 will give you 20,400. So the cum interest price is 20,400. Now from this we will have to subtract interest portion. So we will say less interest. Now always you are supposed to calculate interest on face value. So the face value of this bond is 20,000 and the rate of interest is 6%. But for how many months you are going to calculate? The last due date of interest was 31st December. So from that date we will have to calculate. That means January, February, March, April, and this is 1st of May. So 4 months. So 4 divided by 12. So let us calculate. 20,000 into 6%, we are getting 1,200. So 1,200 into 4 divided by 12 will give you 400. So 400 is the amount of interest which we are going to subtract from cum interest. So if you subtract interest from the cum interest, you will get cost. Which will be 20,000. So if you want, you can just record the month, that is Jan to April. This is just for your reference. The interest which we have calculated is of 4 months from Jan to April. So now we got cost, so we can go ahead and record this in the investment account. The date of transaction is 1st May. We will say to bank account as we are purchasing, and the face value is 20,000. The interest which we have calculated just now is 400. And the cost is 20,000. Done. So let us see what is given next in the question. So the next date is 1st September. But before this, interest date comes, that is 30th June. So first we will have to record the interest part. So again we will have to go to the working note and we will have to calculate interest of 6 months. So accrued interest as on 30th June 2014 for 6 months. Now you are supposed to calculate interest on the balance face value. So let's see what balance do you have. So you can see 1 lakh opening and 20,000 new purchase. So total you have only 1,20,000. So we can write here 1 lakh plus 20,000, that is equal to 1,20,000. Now we'll have to calculate interest, which is at the rate of 6%. So into 6% for how many months? For 6 months. 6 divided by 12. So that will give you, let's see, 1,20,000 into 6% will give you 7,200. So 7,200 into 6 divided by 12 will give you 3,600. So 3,600 is the amount of interest which we will have to record in the investment account. Now you will have to record on the credit side. So you will say 30th June by bank account as you are receiving interest. You will have to directly write in the interest column 3,600. Okay, so this is also done. Now let's see what is next given in the question. Now after June, the next transaction is on September, but before that we have August also. So first we will have to record the August and then September. So August, there is a sale, face value 30,000 at 104 each, come interest. So again we'll have to go to the working note. Let us give the heading for the next working note, fourth working note. Sale as on 1st August 2014 okay. So now you have sold at come interest. So we will say come interest price how many quantity you have sold. 30,000 is the face value, so 30,000 divided by 100, 300. So we'll have to say 300 into selling price is 104. So we will say 300 into 104. Let's see how much we are going to get. 300 into 104, that gives you 31,200. So let us record 31,200 here. Now from this we will have to subtract interest. So less interest, and as you know we are supposed to calculate interest on face value. So the face value of this bond is 30,000. The rate of interest is 6%, and for how many months? The last due date of interest was 30th June, July, August, but this is 1st of August, so only 1 month. So 1 divided by 12. So let's see how much you are getting. 30,000 into 6%, we are getting 1,800. So 1,800 divided by 12. Some big figure, so let me do one thing. 1800 divided by 12, 150. So 150 we will have to subtract from the come interest price. So now the sale value or the sale price, you can say, is 31,200 minus 150. So you will get 31,050. So this is the sale value, which is excluding interest. Now whenever you sell your investment, it is mandatory for you to calculate profit or loss on sale. So in the same working note, we are going to calculate profit or loss on sale. So this is the heading which we are giving. Profit or loss on sale. So the sale value which we got just now is 31,050 less cost of sale. Now cost of sale we don't know actually. We have sold 30,000 ka investment, but 30,000 is the face value. We have sold for 31,050. So we cannot subtract 30,000 from this because 30,000 is the face value. We need to find out cost. So let me show you how to calculate cost of sale. Cost of sale. You need two things. One is face value and the second one is cost. Now initially you got a opening balance. You can see your solution. Initially you had opening balance, then you purchased 20,000. There is no sale, so we will say the opening balance was 1 lakh rupees and the cost of opening balance was 96,000. Then we added 20,000 and the cost of 20,000 is 20,000 only. So now we need to take the total. So the total is 1,20,000. And total value, total face value is 1,20,000, and the cost of face value of 1,20,000 is 1,16,000. Because if you add 96,000 and 20,000, you will get 1,16,000. Now, just see, right now, as of now, you have 1,20,000 ka investment with you, and the cost of this 1,20,000 is 1,16,000. And what we are doing right now is, out of this 1,20,000, we are selling 30,000 ka face value. So if you sell 30,000 ka face value, 30,000 face value ka investment. So what is the cost of 30,000 ka face value? What is the cost of 30,000? We don't know the cost of 30,000. So that is what we are going to calculate. And how we are going to calculate? We are going to calculate by cross multiplying. So you know how to cross multiply, right? So this is what we are going to do. So just calculate and tell me. So how you are going to calculate? You are going to say 30,000 into 1,16,000 and whole divided by 1,20,000. So let's see how much we are going to get. So if we multiply 30,000 into 1,16,000, we are getting something, divided by 1,20,000. So the answer is 29,000. The cost of 30,000 is 29,000. So now what we are going to do, we are going to subtract this. So now you can see the sale value is 3150 and the cost is 29,000. That means you got a profit. So your profit will be 31,050 minus 29,000. 2050. So we will say profit is 2050. Okay, so this is done. Now we'll have to go and record in the investment account. So we will say the date of sale 1st of August. We will say buy bank account. The face value is 30,000 and the interest which we calculated on sale was 150. So now we need to know the sale value. Sale value already we have calculated. So it is 31,050. Okay, now as you are recording sale value on credit side, you will have to record the profit on the debit side. So let us record profit on the debit side of personal account. So we will say 1st of August. To profit and loss account. We are going to write only in the amount column. So the amount of profit that you have gained is 2050. Correct? So let us go for the next transaction. So August done. After August, September. What is there? What is it? It's a purchase. Face value 60,000 at 105 each x interest. So again, let us go to working note. Let's say 5th working note. Fifth working note. purchase as on 1st September 2014. Now X interest price is given to us. Let's see. The face value is 60,000. That means the number will be 600. The quantity will be 600 at the rate of rupees 105. Okay. So we will say 600 into 105. So let us calculate. 600 into 105 will give you 63,000. So 63,000 is your X interest price. Now I will have to calculate interest on this. And interest we calculate always on face value. So the face value is 60,000. 60,000 into 6% into, for how many months? The last due date of interest was 30th June, July, August, only for 2 months. So into 2 divided by 12. Let us calculate. 60,000 into 6% is giving you 3,600. So 3,600 into 2 divided by 12 will give you 600. So 600 is the amount of interest on this purchase. So we don't require cum interest for solution, so we can directly record this. We will say 1st of September to bank account. The face value is 60,000 and the interest part is 600 and the X interest price which we have calculated in the working note is 63,000. So done. Let us see what the next transaction that we have. 1st September over. Now the next date is 1st February, but before that we have due date, interest due date 31st December. So we'll have to record the interest first. Let us go to the working note and record interest. 6th, accrued interest as on 31st December 2014 for 6 months. 6 months. Okay, so what exactly we want? We want the balance. So initially the opening balance was 1 lakh, so you added 20,000 after that, then you sold 30,000, then again you purchased 60,000. So that will give you 120, 180, 1,50,000. So we will have to calculate interest on 1,50,000 at the rate of 6% for 6 months. Let's see how much we will get. 1,50,000 into 6%, so you are getting 9,000. So 9,000 into 6 divided by 12, that is equal to 4,500. So let us record 4,500 here. So this is the accrued interest. Let us go to investment account and record the interest part over here. So we will say 31st of December by bank account. We will record only in the interest column, and the amount of interest that we got from the working note is 1,500. So this is done. Now we can go to the transaction which happened on 1st of February 2015. Face value is 30,000 and the ex-interest price is 102. This is a sale, so again we'll have to go to the working note. So we will give the new heading, 7th working note, sale as on 1st February 2015. So ex-interest price the face value is 30,000. That means the number of bond will be 300. So we will say 300 into the price. The sale price is 102. So 300 into 102. Let's see how much we are going to get. 300 into 102 will give you 30,600. So let us record this here. 30,600. Now interest portion. Interest always we calculate on face value. So face value is 30,000 into 6%. Now for how many months? You will have to see the last due date. The last due date of interest was 31st December. January, February. This is 1st of February. So only for 1 month. That is for the month of Jan. So into 1 divided by 12. Let's see how much we will get. 30,000 into 6%. We are getting 1,800. So 1,800 divided by 12 will give you 150 rupees. So let us record 150 rupees here. So now we do have sale price, that is 30,600, and the interest part 150. Now the next thing is we need to calculate profit or loss on sale. So profit or loss on sale is the heading which we are going to give. It's a subheading. Okay, so let us calculate profit or loss on sale. So we need the sale value. So we will say the sale value is 30,600 because that is the ex-interest price, and from this we will have to subtract the cost of sales. Now we don't know the cost of sales because we need to calculate by cross multiplying as we did earlier. So let's start. cost of sale, we require two things, face value, and the second thing which we require is the cost. Okay, so initially we had 1 lakh. You can see from here, yeah, initially we had 1 lakh, and the cost of it was 96,000. Then we had 20,000, and cost of it was 20,000 only, right? Then we purchased something. So let's see, we purchased 60,000 and the cost was 63,000. Let us go to working note. Then we purchased 60,000. The cost of the 60,000 was 63,000. Okay, so now we will have to calculate. So this is 1,80,000. The cost of 1,80,000 is 96 plus 20 plus 63 will give us 1,79,000. 1,79,000. Now out of this we have sold some investment, and the sale value, face value is 30,000. Okay, fine. So you can see it is given, we can get it from here. We sold 30,000 and we calculated cost also. The cost of this 30,000 was 29,000. So we'll have to record this only. We sold 30,000 and the cost of this was 29,000. So if we calculate this, we will get 1,50,000 as face value, and the cost will be 1,50,000. Correct? Now from this 1,50,000, now again we are selling 30,000. So we need to find out the cost of this 30,000. So we will have to do the cross multiplication. Okay, so if we calculate this, 30,000 into 1,50,000 whole divided by 1,50,000. So you will get, that is equal to, you will get 30,000 only. So now if we subtract this, the sale value is 30,600 and the cost is 30,000. That means again we are getting a profit, and this time we are getting a profit of 600. So let us record, we got a profit of 600. So now we can go to investment account and we can record here. We will say 1st of Feb by bank account. The face value is again the same like previous sale, 30,000, but this time the interest which is accrued is 150 and the sale value or the sale price which you can say is 30,600. Now as you are recording sale price on the credit side, profit you will have to record on the debit side. So again we will say 1st of Feb on the debit side, and to profit and loss account, we will directly write in the amount column. This time we got a profit of 600. So it's done. Now let's see, is there any transaction left? Let us read once. It's done. All the transactions are over. Now at the end, one thing is given, that is market value of his entire investment was rupees 1 lakh as on 31st March 2015. Okay. Now we need to find out the balance. Now we need to check about the valuation part. So we will give them new heading, eighth working out. Valuation as on 31st March 2014. Now let us find out the balance. We need to take the total. So let us go to investment account. We'll have to take the total of face value and total of cost. So let us take the total on both sides. So here your total is 1,80,000. Okay, and then same total we are going to record here. $1,80,000. Now this from 1,80,000, you need to find out the balance. So balance which you are going to get here is 1,80,000 minus 60, 1,20,000. So this is our balance. Face value, we can circle this balance. This is a balancing figure, and here we will say 31st of March. We will say by balance carried down 1,20,000. Same way, now we will have to take the total of cost. So if you take the total of cost, let me find out, 96,000 plus 20,000 plus 2050 plus 63,000 plus 600. So you are getting 1,81,650. So let us record this here. 1,81,650. Again, same total we are going to record on this side, 1,81,650. Now yes, now let us go to the valuation part. The market value, let us calculate book value first. How we will get book value? The total cost which we got just now from the debit side is 1,81,650, right? From that you will have to subtract the credit side. So you can see debit side total is 1,81,650. From this you will subtract credit side. So total of this will be 61,650, 31,050 plus 30,600. So let us subtract 61,650. You will have to subtract from 1,81,650. So you will get 1,20,000. So this is the book value, right? And And what is the market value? Market value, this you will get from the question. So you can see the market value of the entire share as on 31st March is 1 lakh rupees. So let us record here. The market value of entire share is 1 lakh rupees. So now if you find the difference, you're getting difference of 20,000. Now what is this 20,000? Book value, that means from your investment account you can see you're getting 1,20,000, your book value, and the market value of this investment is 1 lakh rupees. That means you got a loss. So you can say loss on valuation. Loss on valuation is 20,000. So now this loss we will have to record in the solution. As profit you are recording on the debit side, loss you will have to record on the credit side. So we will say March 31st by profit and loss account $20,000. So loss we have recorded. Okay. So now if you see, anyways, you will have to find out the balance. So let's see, 1,81,650. Let me write once again. 1,81,650 minus 31,050 minus 30,600 minus 20,000. So now you can see the balance which you have right now is 1 lakh rupees. So let us record 1 lakh rupees here. So this is your balancing figure. So let us circle this also. Now the next thing is we will have to close the interest column. So let us check the total of interest. Now if you see debit side 1,900, okay, so this credit side is more. So let us find out the total of credit side. 3,600 plus 150 plus 4,500 plus 150. So that will give you 8,400. Now one thing is missing over here is the interest part. We have not calculated the accrued interest as on 31st March. So let us calculate that as well. Accrued interest, 9th working note. Accrued interest as on 31st March 2016. Now what balance do you have? What is the face value which you have balance? 1,20,000. So that means we will have to calculate interest on 1,20,000. 1,20,000 into 6% for how many months? Yeah, last due date was December. So January, February, March, 3 months. 3 divided by 12. So let us calculate. 1,20,000 into 6% will give you 7,200. So 7,200 into 3 divided by 12 will give you 1,800. So we can record here the accrued interest at the end of the year is 1,800, and same thing we will have to record in the solution as 1,800. Right? So this is not a balancing figure, so please don't circle this. Now in your calculation, just calculate once again 3,600 plus 150 plus 4,500 plus 150 will give you 8,400. So let us record 8,400 as $3,600 plus 150 plus 4,500 plus 150 plus 1,800. Last time I forgot to take 1,800, so it's 10,200. 10,200 is the total of interest column. Same total we'll have to write here 10,200. Now from this 10,200 we will have to subtract the debit side. So 10,200 minus 1,500 minus 400 minus 600 will give you 7,700. So you will have to record here 7,700. Now this is the actual income, or you can say net income, which you are going to transfer in profit and loss account. So you will have to write here 31st of March to profit